Morning, everyone. Welcome to this morning's edition of MPC Markets Morning Call, 21st of August, 2025. Stocks stumbled into Jackson Hole and in NVDA earnings next week. It was the fourth consecutive day we've been weaker in the NASDAQ. As you can see there, the hourly technicals now turning to a strong sell, and even the daily's turning to a neutral. We've got a neutral in the Russell and the S&P. The Dow still hanging in there. More so around that sort of rotation out of tech as investors are generally a little bit worried about valuations in the tech sector overall. You can still sort of see our market is still is showing a strong buys on all the technicals there. Had a reasonable day yesterday. Everyone's been pretty surprised that we've survived well, all things considered. We'd be considerably higher had CSL not have disappointed, and James Hardie particularly. But I would expect that those two stocks they'll eventually grind higher. I mean, the results weren't obviously to market expectations, and certainly to investor expectations. But realistically, we saw a 30% move in James Hardie yesterday, with a drop of 16% in rev. I was more disappointed in the fact that US home builders have been doing well, and James Hardie was disappointing and missed wildly on guidance. Like 16% is just kind of unacceptable, to be honest. CSL as well. I just think investors they finally just got frustrated, I think, in the end. And it's just one in a long line of everyone calls CSL to go up into earnings, and this is the year that it's going to go to $400. And it just sort of hasn't happened. I think it's probably a bit of a capitulation for many, but look, it's currently at 5-odd-year lows. Realistically, and I don't really think that's remotely justified in terms of in terms of a reaction to what came out the other day. And now, but as per usual, the Australia being the possibly the most negative market in the world, the parade of people who said nothing prior to the earnings because it was wildly buoyant on CSL. Across the board. Now everyone's come out of the woodwork going, oh, there's problems with the company, blah, 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 blah. All the while, we have retailer JB Hi-Fi now trading at a higher forward PE and a higher PE and forward valuations than CSL, which for a retailer realistically is just absolutely absurd. But it joins the JB Hi-Fi, Wesfarmers, CBA. They're the three favourites of the ETF camp. Basically, it's where all the money flows, and it doesn't matter how stupid things get. The money just seems to go in there blindly on a long-term basis. So, look, the Nikkei had a bit of a drop yesterday. China A50 was up a little. Iron ore, I think, probably dragged us up towards the end of the day. Dow yet again was fairly flat. S&P down a quarter, Nasdaq down 0.6, and the Russell down 0.4 there. As you can see, yet again, fairly pronounced in terms of selling tech and buying the rest of the market. I tend to agree, and some heat will come out of this market. But realistically, if you're looking at a lot of these companies, Microsoft, Apple, Amazon, and Google in particular, and probably the likes of Oracle, they're a hell of a lot cheaper than the likes of CBA, JB Hi-Fi, and Wesfarmers, and more than justifying the forward growth. So I think it is just really investors taking some, and fund managers taking some money off the table. And we spoke yesterday about these valuations being extraordinarily high. So never, and I had a tiny bit of feedback yesterday. Obviously, I'm not trying to be alarmist and panic, and I'll show you in a minute why. But look, as it stands at the moment, all of these major metrics, are overvalued or severely overvalued, and we saw credit spreads drop to the lowest point since 1998, which means that there's essentially it's getting towards being over leveraged as well. I think a pullback in the scheme of things would be healthy. I don't think this is sustainable here at the moment, and I'm not praying for a clean out necessarily. But there are a certain number of stocks in many of the indexes which are just sitting at very unjustifiable highs at the moment, and a fair bit of leverage is being used. So margin debt being at elevated levels. And nearing record highs is never a good thing when leverage is coming in, and then we'll be monitoring credit spreads quite closely, because that is a very, very reliable indicator. But as you can see here, August and September are the only real ones that are weak to negative. September's the only one on average that has a that has a negative result. So that seasonal weakness lines up with this overvaluation. However, never fear. The bears do not dominate long, and I've done a fair bit of statistical study over the last. Well, I'm always doing these statistical studies, but particularly in the course of the last week, pulling together some hedging strategies or an insurance policy per se for a market fall. For those of you who are sophisticated investors, it's around about the $3,000 to $3,500 mark cash down for 100 grand's worth of cover. So very, very cheap in terms of being able to cover your portfolio for a very low cost, and only really 3 to 3.5% maximum downside on the notional. So it's a very good product, and it is essentially the product of volatility being very low and us being at record highs. No one wants downside cover. So the insurance product is for around about 3 months, and this is why basically. So if we take into account, I've spoken about in the past, pre-2009 markets went sideways for long periods of time. The average period to break even was like 500 days. And so, you're talking a year and a half just about. Since 2015, and obviously rates being at fairly prolonged, emergency levels or around zero, definitely under sort of 5%, we tend to not go sideways at any stage. We tend to just overextend at the bottoms and tops of the ranges. And the max drawdown from the record high on average is around about that 21% mark. And then the days to break even, 120 days. I mean, we're talking 3 to 4 months. So the bounce happens very quickly. Again, it was 80 days to push back to break even, and then we went to a record high. And the shortest one here was about 70 days, and not technically a bear market there. It's only down 16%, but even at 148 days for COVID, down 34%. Realistically, that fall there is nearly 1.5 times the 1.7 times the average fall from a record high, and it's bounced back almost within 20 days of the break-even average. So I think it's quite extraordinary. And this one here in 2022, I think was one of the longer ones. But look, I think that evens about right, and we do tend to freak out, and the bears they never dominate long. Look at these bull markets here in the green, and then the bear markets. So you can see here, days to break even, average length of bear markets since 1960 is 289 days. So we're less than half that these days. The market moves so much faster. So and the falls happen quicker as well. But look, I mean, look at the length of these bull markets versus the bear markets. I mean, you've just got to be. I believe this is statistically a very good time to either have a hedge on or be going back to cash. But fear not. I will be very quickly on the buy button like we did in April. With the shopping list at almost written on the back of my hand in Sharpie for 2 or 3 weeks, because we'll be. I think it'll be one of the better buying opportunities over the coming years, because Trump will get rates down and he'll do it via probably some very choosy economic numbers being soft, and then they will basically cut rates, and we'll bottom out very quickly, I would say. And he's going to have his own people on the Fed soon as well, so he'll keep those rates lower for longer, and we will possibly, I think, we'll have an absolute rip tearing rally in the last 2.5 to 3 years of his presidency, because he's a megalomaniac, and that's what he loves, pushing out that stat that the stock market was up 86% or something the last time he was in. So we've got Goodman's, Northern Star, Brambles, Sonic Healthcare, Telix, Netwealth, Whitehaven today. Overall, I think Northern Star had a fairly decent result. EPS was in the range, but slightly beat on the dividend. Positive surprise versus capex. I think Northern Star is probably fairly cheap. Goodman's is one that I figured would be a really good result, because the REITs have done very well. And I'm just flicking through their operating profit was up 13, revenue was up 16, and their other income surged 327 odd %. So they beat on EPS, positive surprise on statutory profit, and in line on dividend. So I would imagine that Goodman, I mean, it's a crowd favourite, let's face it, and we were considering having it as an earnings play this week, but just broader, we just don't want to get caught out with things. The way that the numbers have been in the if you miss by 1%, you get smashed. If you beat by 5%, you barely go up. So I just not loving the ASX market, I've got to say right now. And then just having a very quick look at Telix, validate growth and operational scalability. There's some margin pressures, but we've already sort of had that news. And then everyone's just worried about this SEC inquiry overhang, etc. For those of you who want to go into more detail, go to the website. In our education section, there is an article on Telix as well. If you also want to have a look at more statistics on those market falls and then the preceding bounce, there is also an article there I wrote this morning as well, with tables, etc., where you can have a look. But those sorts of knowing those statistical averages and things means that when everyone else is running around like Chicken Little thinking the sky's falling, those stats will give you the courage to buy overall. So US dollar was largely flat overnight, but I mean, we did see a bounce back in gold, silver, and platinum crude and iron ore, which is probably a little bit risk on, really, I've got to say. Coal was up slightly, lithium's bouncing around, obviously uranium having a horrible week, and Bitcoin made a small recovery as well.
General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.